Please like, share, and subscribe. Wishing you happiness and good luck every day.
If you've been investing for any length of time, you know the feeling, right? The market zigs, it zags, and most of the time it feels like you're just getting tossed around. I've definitely been there, chasing the next hot stock, convinced it was the one, only to get burned. But what if there was a totally different way to play the game? A time-tested strategy for long-term security that gets you off the roller coaster and focuses on what actually truly builds wealth. Well, today we're breaking down a proven system that does just that. Man, this quote just hits the nail on the head. As investors, there's this constant battle for our attention. Over on one side, you've got the flashy, exciting, cutting-edge tech company that promises to, change the world. That's the glamour. And on the other side, you've got a company that just makes stuff and sells it profitably for decades. This is the exact conflict we're going to tackle. The siren song of those risky, high-growth stocks versus the steady, often kind of boring power of truly profitable companies. Oh, I remember the dot-com era like it was yesterday. I was right there in the middle of it, totally swept up in the craziness. And it was almost impossible not to be. You had stocks like eToys, this so-called category killer, or Webvan, which was going to revolutionize how we all buy groceries. There was this intense pressure, this feeling that if you didn't speculate, if you didn't jump on these rocket ships, you were going to be left in the dust. And of course, we all know how that story ended, don't we? Both of those stocks went to zero. Okay, so here's our game plan. First, we're going to dig into why that glamour stock approach is such a trap. Then, we're going to uncover the hidden engine that has secretly been powering the market for decades. After that, we'll meet an elite group of companies known as the dividend aristocrats and see how they create this unstoppable compounding snowball. And finally, we'll break down a super actionable formula, the 10-11-12 system, that turns all this theory into a perpetual income machine for you. So if you're ready to trade that glamour for some real profits, let's dive in. So let's go back to that dot-com example. Picture this. It's late 1998. You could have put your money into the category killer, eToys. Or you could have put it into the decidedly boring Johnson & Johnson. Well, while eToys was completely out of business within 18 months, that boring J&J stock, if you reinvested the dividends, would have returned an average of 8.6% per year over the next 13 years. That's the difference between losing everything and nearly tripling your money, during a time when the market as a whole was basically flat. All of a sudden, boring starts to look pretty beautiful, doesn't it? This right here, this is the crucial mindset shift we all need to make. We have to stop thinking of stocks as just these little lottery tickets and start seeing them for what they really are, a piece of ownership in a real business. The book uses this fantastic analogy. Imagine your brother-in-law comes to you and says, hey, I want to open an Italian restaurant. I've got a great spot, an amazing chef, a solid business plan. I just need some capital, and I'm offering you a partnership stake. You're not just buying a piece of paper. You're becoming a part owner in a real, living, breathing business. Okay, so now you're a partner in that restaurant. Let me ask you, what would you prefer? Would you want your brother-in-law to say, hey, listen, we're not paying out any profits. We're just going to hope we can sell this place for a huge pile of cash in 5 years? Or would you rather he said, business is good, the restaurant is profitable, here's your cut of the profits for the year? I think we'd all want that annual payout. Well, that payout, that share of the profits, that's a dividend. Simple as that. And this brings us to the big aha moment of this whole thing, what I like to call the market's hidden engine. We get so focused on the daily up and down of stock prices that we completely miss the massive, incredible impact that these regular profit payouts, these dividends, have on building real long-term wealth. Just take a look at this chart. That little bar on the left shows what happens to $100 based on price alone. It grows to almost $5,000. That's respectable. But now, look at that towering bar on the right. That is what happens when you reinvest the dividends. Your $100 doesn't just grow. It explodes to over $117,000. The difference is it's absolutely staggering. Let's put one single number on that, 95.8%. Let that sink in. That is the chunk of the market's total return since 1929 that came from one thing, reinvesting dividends. So the point is, if you ignore dividends, you are willingly ignoring almost all of the market's historical power to generate wealth. It's like trying to power a car while completely ignoring the engine. It just doesn't make any sense. Okay, but here's the thing. Not all dividends are created equal. So if dividends are the engine, how do we find those high-performance, super reliable businesses that can actually keep running for the long haul? Well, lucky for us, There's a blueprint. It's time to meet a very special class of companies. They're called the dividend aristocrats, and this is the absolute gold standard. To get into this club, a company has to be in the S&P 500, and this is the important part, it must have increased its dividend every single year for at least a quarter of a century. Why does this matter? Well, it means these aren't just any companies. They usually have a powerful brand, a key patent, or an essential product, something that people need no matter what the economy is doing. You know, a company like Genuine Parts. They've raised their dividend every year since 1956. Think about that. Through every recession, every market crash, every single crisis, they just kept doing business and giving their shareholders a raise. Now, the aristocrats are a great place to start, but it's a pretty exclusive club. So to find more potential investments, we can look at a few other categories. You've got the champions, who have that same 25-year track record but aren't just limited to the S&P 500. Then there are the contenders, who have raised dividends for 10 to 24 years, and the challengers, with a solid 5 to 9-year streak. And this is where it gets really interesting because you start to see a bit of a trade-off. The established champions have that solid, steady dividend growth. But look over at the challengers. These are the younger companies. They often have a higher starting payout, and they're growing those dividends much faster, at almost 11% a year. So you've got a choice. Do you want the proven safety of the old guard or the higher growth potential of the up-and-comers? So we've found our quality companies. Now it's time to unleash a force that Albert Einstein supposedly called the eighth wonder of the world, the most powerful force in the universe, compounding. The best way to picture it is to think of a small snowball at the top of a very, very long hill. As it starts rolling, it picks up more snow, getting bigger and faster, and the growth just becomes exponential. So to really hammer this home, let's do a quick thought experiment. Let's imagine the absolute worst-case scenario for a stock investor. A totally flat market. You buy a stock for 10 grand, and for the next 20 years, its price doesn't go up by a single penny. Is it even possible to make any real money? Okay, let's say our stock pays 4% dividend, and that dividend grows by 10% a year. So after year one, you reinvest your dividends, and your initial $10,000 is now worth $10,406. It's barely noticeable. And honestly, this is the point where most people get bored and just give up. The snowball is still tiny, and the progress feels painfully slow. But we stick with it. We let that little snowball keep on rolling. And now, halfway through our 20-year timeline, at the 10-year mark, we check again. Our initial $10,000 has now grown to almost $19,000. See? That snowball is picking up some serious mass and speed. The growth is starting to accelerate in a very real way. And now for the grand finale. After 20 years of reinvesting those growing dividends with absolutely zero help from the stock price, that original $10,000 investment is now worth nearly $95,000. It's almost hard to wrap your head around, isn't it? This just shows you the incredible, almost unbelievable power of compounding. It took a completely dead-in-the-water investment and created a nearly tenfold gain just by patiently reinvesting the profits. Okay, that's the wow factor. But theory is one thing. How do we actually put this into practice? Let's get into the actionable formula from the book. It's beautifully simple, and it's called the 10-11-12 system. 10 stands for the time frame. You're in this for at least 10 years to let that snowball really get rolling. 11 is your income target. After those 10 years, the dividends you're getting each year should equal 11% of the money you first put in. So if you invested 10 grand, you'd be aiming to get $1,100 a year in cash just from dividends. And 12, that's your total return target. You're aiming for an average annual return of 12% over that decade. It's a simple, clear method for getting specific, double-digit results. So let's bring this all home. We've gone from avoiding the glamour stock trap all the way to understanding how to build a machine that can work for you perpetually. The core principles are basically simple rules to live by. First, you have to save. Pay yourself first, always. Then you invest that savings into quality companies, those champions, contenders, and challengers we talked about. You reinvest every single penny of dividends, and you let the magic of compounding do all the heavy lifting. What this does is create an income stream that doesn't just keep up with inflation, it absolutely crushes it. And maybe the best part of all, you can sleep well at night knowing your wealth is being built on a solid, proven foundation, not some risky bet. And what is the real life-changing potential of all this? I just want you to listen to this quote from the book and really let it sink in for a second. Earning an average of 12% per year for 20 years turns a $100,000 portfolio into nearly $1 million. That's the destination. That's the power of sticking with this system. You know, in the end, it all comes back to that first big mindset shift. Your portfolio isn't just a collection of ticker symbols, it's a business that you own, just like that Italian restaurant. You've invested your hard-earned capital into it, and for years, maybe you've been reinvesting all the profits to help it grow. So the real question is, isn't it time for that business to start paying you back?
You know, if you've ever felt completely lost trying to figure out the world of investing, believe me, you are not the only one. Today, we're going to cut through all that noise and take a look at a really powerful, time-tested strategy that, honestly, a lot of people seem to have forgot about. So let's just dive right in.
And this really is the big question, isn't it? I mean, every single day you're getting hit with the next can't-miss stock tip or some super complex new theory. All that noise, it can make you feel like you're just at a casino, rolling the dice with your own money. The whole point of this explainer is to show you a clearer, more reliable way forward.
You look at the stock market, and it's like this giant maze of competing ideas. You've got the value investing folks over here, the growth people over there. Then you have momentum traders and guys who swear by reading charts. Look, they all claim they've found the one true path to riches. But the reality? None of them work all the time. They all have their day in the sun, and they all have times where they fail spectacularly. And that really gets to the heart of the problem here. I think somewhere along the way, after years of pretty decent, steady returns, a lot of us just got impatient. We started chasing lottery tickets instead of solid investments. And in the process, we forgot what it actually means to own a stock.
To really get what happened, we've got to go back in time. Let's talk about the dot-com bubble. It's a painful memory for some of us, but it is the perfect example of what happens when hype just completely takes over. I mean, stocks were jumping 20, 30 points a day. The excitement was it was everywhere.
And look, I want to be really clear about this. I'm not pointing any fingers here. I'm not judging. Because I was right there in the middle of it all. I was day trading those crazy internet stocks, trying to catch the next big pop. And yeah, I had some huge wins, but I also got absolutely crushed when the music stopped. I think I still have a stock certificate for a company called Quokka somewhere in a box. It went bankrupt in 2002. Trust me, it was a lesson I'll never forget.
This right here, this just lays it all out, doesn't it? On one side, you had e-toys. Everyone was screaming that it was the next category killer in toys. On the other side, you had Johnson & Johnson, a boring old company that paid a small 1.7% dividend. Well, e-toys was bankrupt in a year and a half. Johnson & Johnson? It just kept chugging along, returning almost 9% a year. Your money would have nearly tripled.
So what was driving all this madness? It was something called the greater fool theory. The idea wasn't to buy a piece of a great, profitable company. No, the game was to buy a ridiculously overhyped stock, knowing it was worthless, and just hope you could sell it to some other person, a greater fool, for an even higher price before it all came crashing down. That's not investing. That is pure gambling. Okay, so after all that chaos, what was the big idea that we all just forgot? It's actually incredibly simple, but it is so powerful. It's the idea that when you own a stock, you own a piece of a real business. A business that's supposed to make money and then share some of that money with you, the owner. And this is the single most important thing to get. A stock is not just some blip on a screen. It's not a ticker symbol. It represents actual ownership in a real company, with buildings, employees, products, and hopefully profits. Just making that mental shift changes everything.
Let me put it this way. Imagine I come to you and say, hey, I'm opening a new Italian restaurant, a trattoria. I need a partner. If you invest $100,000, I'll give you a 10% ownership stake. Now, you've got a choice. Would you rather just wait for years maybe, hoping I eventually sell the whole restaurant for a big one-time profit? Or would you rather I give you your 10% cut of the profits every single year? Now, what if I made you another offer? What if I said you could take that yearly profit check and use it to buy an even bigger slice of the restaurant? That is the magic of reinvesting dividends. You're using the business's own profits to buy more of the business, which then generates even more profits for you down the line.
Look, this sounds nice in theory, right? But the proof? Well, the proof is in the numbers. And believe me, when you see them, they are absolutely mind-blowing. Okay, just look at this chart. It tells the whole story. If you'd invested $100 in the S&P 500 back in 1929 and just tracked the price, you'd have ended up with about $5,000 by 2010. Not bad. But now look at that second bar. If you had taken all the dividends paid out over the years and just bought more stock with them, that same $100 would have turned into over $117,000. That's insane. It means that nearly 96% of the stock market's total return over that long period came from those reinvested dividends.
And it's not just about getting huge returns. It's about consistency. It's about a win rate. The data shows that if you just bought the market index, dividends included, and held on for any 10-year stretch since 1937, you had a 91% chance of making money. The only times you didn't were connected to catastrophic events like the Great Depression. In the world of finance, that is about as close to a sure thing as you're ever going to get.
All right, now this next part, this is where it gets a little crazy, in a good way. Check out this scenario. You put $10,000 into a dividend-paying stock. Over the next 10 years, the stock price actually goes down by 13%. So you lost money, right? Wrong. Because you were reinvesting those dividends the whole time, your $10,000 still grew to around $17,000. It absolutely crushed a safe government bond. Think about that. You can actually win big, even when the stock price itself is a loser. There's another huge enemy we're all fighting, whether we realize it or not. It's that hidden tax called inflation. The money in your pocket just buys less and less every year. A safe 2 or 3% bond just isn't going to cut it when the cost of something like college tuition is going up over 8% a year. But a portfolio of great companies that are committed to raising their dividend payments every year, that is a machine designed to grow your income stream faster than inflation, protecting your real buying power for the long haul.
Okay, the evidence is pretty overwhelming. But the big question is, how do you actually do this? How do you put it into practice? You need a system, right? A simple framework that actually works and doesn't require you to be a financial genius staring at a screen all day. So let's talk about one. Any good system, in my book, has to pass 3 simple tests. First, it's got to be easy to understand, like 10-year-old easy. Second, it has to actually work, based on real history, not some academic theory. And third, it has to be cheap. It should be something you can set up and pretty much let run on its own so you're not getting eaten alive by trading fees. So the goal of this particular system is pretty clear. It's called the 10-11-12 goal. The idea is that in about 10 years, you're aiming to get an 11% yield in cash dividends based on the money you first put in, while hopefully hitting a 12% average annual return overall. Now that's not magic. The way it works is by finding quality companies that have a decent starting dividend, but, and this is the key, they also have a long track record of increasing that dividend payment year after year. That growth is the engine that makes the whole thing compound. Now, of course, nothing is guaranteed. Companies hit rough patches, they can cut dividends. That's why the focus is on a whole basket of these durable, proven businesses, not just chasing whatever has the highest yield this week. So let me just leave you with this one final thought. What if you changed your whole mindset? What if you stopped trying to guess which ticker symbol is going to pop next week, and instead, you just focused on owning pieces of great businesses that send you a bigger and bigger check in the mail, year after year, just for being a loyal owner? What if your investments started paying you to own them? That right there is the real power of focusing on dividends.
So when you think about exciting investments, what's the first thing that pops into your head? Cutting-edge tech, right? Maybe some groundbreaking biotech company? Well, what if I told you that one of the most powerful, most reliable investment stories out there comes from a place you'd never ever expect? A place that, honestly, looks downright boring on the surface. Okay, let's get into it. Here's what we're going to cover. First, we'll dig into why boring can actually be incredibly exciting. Then, we'll nail down what a dividend raiser really is. After that, we'll explore the different leagues they play in, from the absolute elite, the aristocrats, all the way to the up-and-comers. We'll weigh the classic trade-off between a fast growth rate and a long, proven track record, and we'll wrap it all up with a unique, powerful advantage that you have as an individual investor. All right, first things first, let's pull back the curtain and see how something that seems totally mundane can be the foundation of a truly powerful story about creating wealth over the long haul. No, seriously, think about this for a second. Are you going to be at a barbecue bragging to your friends about your big score on a company that sells oil filters and spark plugs? Probably not, right? But should you be excited about it from an investor's point of view? Let's find out. Okay, let's talk about a company called Genuine Parts, ticker GPC. This is pretty much the definition of a boring business. You probably know them as Napa Auto Parts. You're not going to see these guys on the cover of Wired magazine. But their financial story? Oh, that is where things get really interesting. So what's the deal with 1956? Well, that was the very last year that Genuine Parts did not increase its dividend payment to its shareholders. The last time. I mean, just let that sink in for a moment. Dwight Eisenhower was president. Elvis had just hit the scene on TV. We're talking about a long, long time ago. And this is what's so incredible. We're talking about the Cuban Missile Crisis, Black Monday in '87, the dot-com bust, 9/11, the Great Recession in '08, a global pandemic. Through every single one of those world-shaking events when the news was screaming that the sky was falling, Genuine Parts just kept on doing its thing, selling parts and sending its investors a bigger check than the year before. Every single year. That kind of consistency, it's not just boring. It's absolutely beautiful. So the Genuine Parts story isn't some weird fluke. It's actually a perfect real-world example of a really powerful investment concept. Let's break down how this idea of consistency becomes a core principle you can actually use. Back in the day, before I was digging deep into financial statements, I was learning about stock charts, and this was lesson number 1. A trend in motion stays in motion. It just means that something, whether it's a stock price or, in our case, a dividend, is probably going to keep heading in the same direction until a major force comes along and knocks it off course. And that, right there, leads us to our key definition. I like to call these companies perpetual dividend raisers. See, for them, it's not a one-time decision. It's a habit. It's baked into their corporate culture. The people running the company know that their shareholders expect that dividend to go up every year, and breaking that streak is the absolute last thing they ever want to do. Okay, so within this whole world of dividend raisers, there is this super exclusive members-only club. These are the rock stars, the household names you all know. They are the bluest of the blue chips. They're called the dividend aristocrats. And let me tell you, getting into this club is tough. The bouncers are incredibly strict. First off, you've got to be a big deal, a member of the S&P 500. Second, and this is the big one, you need that 25-year-plus track record of raising your dividend. No excuses. And finally, you have to be a large, heavily traded company so big institutions can get in and out easily. This is the big leagues, folks. Now, the aristocrats are amazing. They're the gold standard. But it's a really small group, usually only around 60 or so companies. If we just stop there, we're going to miss out on a lot of fantastic opportunities. So it's time to cast a wider net. And this table here lays it all out for us perfectly. It broadens our view quite a bit. A dividend champion has that same 25-year streak as an aristocrat, but without all those other strict rules, like being in the S&P 500. Then you have the dividend contenders, with a solid 10 to 24-year streak. And finally, you've got the newcomers, the dividend challengers, with 5 to 9 years under their belts. Okay, and this is a really important point to get. Every single dividend aristocrat is also a dividend champion. But the champion list is much bigger because it also includes tons of other great companies that just aren't in the S&P 500 or don't meet those other size rules. It's a much more inclusive list and, as we're about to see, a very interesting one. So the big question you're probably asking right now is, okay, which group is better? Should I go for the one with the longest, most proven track record, or the one that's a little younger, a little hungrier? Well, that brings us right to one of the most classic trade-offs in all of investing. Just take a look at these numbers. The champions, the ones with that 25-plus year record, they have the lowest starting dividend yield and the slowest growth rate. But as you move down to the contenders and then to the challengers, look what happens. Both the starting yield and, this is the important part, the growth rate of that dividend get higher and higher. The younger companies are growing their payouts way faster. And if you're wondering just how much of a difference that growth makes, well, this chart says it all. Over 10 years, that faster growth from the challengers really starts to compound in a big way. On a $10,000 investment, the average challenger would have paid you over $1,500 more in pure cash income than the average champion. That's a huge difference. So what this all boils down to is a classic investment choice. Do you go for the safety, the near certainty of a champion with that incredible track record? Or are you willing to take on a bit more risk with a challenger's shorter history in exchange for a higher starting income and much faster growth? There's no right answer here. It really depends on what you're trying to accomplish. Now, hold on. Before you run off and pour all your money into the challengers, there's a really critical catch we need to talk about. It's called survivorship bias. All those nice, clean numbers we just looked at, they only show the companies that made it, the ones that succeeded. We're not seeing all the companies that tried and failed along the way. And this is not just some theory, okay? This stuff happens. Take a company like F&B Corp. For 35 straight years, they were a rock-solid dividend champion. And then the 2008 financial crisis hit. In 2009, they had to slash their dividend in half. And just like that, a 35-year trend was gone, and they were kicked off the list. The risk is absolutely real.
Okay, so we've looked at the different kinds of dividend raisers and the big trade-offs between them. But now we get to my favorite part. Let's talk about a massive, and I mean massive, advantage that you have as an individual investor over the biggest, smartest pros on Wall Street.
Think about a guy managing a huge mutual fund. He has to invest, say, $50 million. He can't just go buy a small company. His buying alone would send the stock price to the moon. And if he needed to sell, he could crash the price because there just aren't enough buyers. He's forced to fish in this tiny, crowded pond of huge, well-known stocks. You, on the other hand, you can go anywhere. You have total freedom. And this, right here, is your superpower. You can go through that big dividend champion list and find these incredible hidden gems that the pros physically cannot touch. A company like Tompkins Financial, for instance. It's a fantastic little bank with a 25-plus year streak, but it's way too small for a big fund to even look at. You can buy these great little companies, fly completely under the radar, and find opportunities the big guys can only dream of. So, I'll leave you with this thought. We've seen that a trend in motion tends to stay in motion. And we now know that you have access to a whole universe of companies that the professionals are forced to ignore. So the only real question left is, what kind of trend are you going to start looking for?
All right, welcome. Today we're going to talk about an investment strategy that kind of flips one of the oldest warnings in finance right on its head. It's a way of finding predictability in a world that, let's be honest, is famous for being anything but predictable. So let's get into it.
You've seen this a million times, right? It's that fine print on every single investment ad. It's the big disclaimer that basically says, hey, the stock market is a wild ride, and just because something went up yesterday doesn't mean it's going up tomorrow. And for the most part, that's a pretty good rule to live by. But is it always true? Well, it turns out there's a really interesting wrinkle to that old rule. You see, while a stock's price can bounce around like a pinball, a company's history of paying out, and more importantly, increasing its dividends, well, that tells a very, very different story. It's a story about stability, about financial health, and about a serious, long-term commitment to shareholders.
So here's how we're going to break it all down. First, we'll dive into this whole past performance exception. Then, we'll introduce you to the elite club of companies that are the stars of this show. After that, we'll look at the incredible math that makes this all work, the compounding snowball. Then, and this is the cool part, we'll see how this strategy can actually make you a winner when the market is tanking. And finally, we'll talk about why this is all about working smarter, not harder. Okay, so let's get right to the heart of this. Just think about it for a second. A company that has given its shareholders a raise year after year for 25 years straight. That means they've survived recessions, market crashes, tech bubbles bursting, you name it. For a company to keep that streak going into year 26, that's not just a numbers decision. That's a statement. It's them keeping a promise they've been making for a quarter of a century. And yeah, these companies actually have a name. They're called Perpetual Dividend Raisers, or the fancier term, Dividend Aristocrats. This isn't just a fun fact, it's a whole identity. It tells you that these businesses are run for the long haul, with the people who own the company, the shareholders, as the top priority. So let's meet these so-called aristocrats. I mean, just how reliable are we talking here? When you actually look at the track record, the consistency, it's just amazing. Look at this number. In any given normal year, there's a better than 90% chance that one of these companies will raise its dividend again. I mean, think about that. In the world of investing, getting something that's over 90% certain, that is about as close to a sure thing as you're ever going to get. But what about when things get really bad? I mean, really bad. Remember the 2008 financial crisis? The whole global economy was teetering on the edge of a cliff, and yet even then, a full 80% of these companies still managed to give their shareholders a raise. That's not just reliability, that's incredible resilience. Okay, that's great, but does it actually make you money? Well, take a look. Research from Ned Davis looked at what happened to $100 invested between 1972 and 2010. If you put it in companies that were consistently growing their dividends, that $100 turned into over $3,500.
If you invested in companies that didn't pay dividends, you got less than 200. And the companies that cut their dividends, you actually lost money. The difference is just, it's night and day.
So, what's the magic here? What's the engine that's driving this kind of massive outperformance? It's not just getting those dividend checks in the mail. No, it's something far more powerful. It's the magic of compounding.
I absolutely love this quote because it paints the perfect picture. You know, when you first start, compounding feels slow, almost boring. You might not even notice it, but you have to be patient because once that snowball gets some size and starts rolling downhill, the momentum just takes over and the growth becomes absolutely explosive. Let's just run some simple numbers. Say you put 10 grand into a stock that pays a 4% dividend, and that dividend grows by 10% every year. Okay, so in year 1, you make $400. Nice, but nothing to write home about. But you stick with it. By year 20, that annual income is almost $2,500. Your yield on cost, the return you're getting on your original 10 grand, is now over 24% every single year, and it just keeps going up from there.
And this isn't just some fantasy spreadsheet calculation. Let's look at a real-world example, a classic dividend aristocrat like Procter & Gamble. Over the past decade, its total return was nearly 115%. The broader market, the S&P 500, was up just 33%. This supposedly boring company just quietly left the market in the dust.
Okay, now hold on to your hat because this is where it gets absolutely insane. If you had invested in Procter & Gamble way back in 1981, and remember, even then it was already a well-established dividend grower, the yearly dividend check you would get today would be equal to 84% of your entire initial investment. Let me say that again. You'd be getting almost all of your original money back every year just in dividends.
And just to prove P&G isn't some weird fluke, let's look at another one, Coca-Cola. Same deal. A $10,000 investment in 1981, with all the dividends reinvested, would be worth just under $1 million today. From $10,000. That is the jaw-dropping power of compounding and time.
All right, I know what you're thinking. This all sounds wonderful when the market's going up, but what happens when everything hits the fan? Well, this is where the strategy gets really interesting because it has this totally counterintuitive superpower. You can actually come out ahead when prices are falling.
This is the question that keeps investors up at night, isn't it? A long, grinding bear market where prices just keep dropping. It's the ultimate stress test for any strategy. So let's just tackle this fear head on.
Now you have to pay close attention to this table because this reveals the secret weapon. Notice the stock price. It starts at $20 a share, and 20 years later, it's down to just over $12. By any normal measure, that's a losing investment, right? Wrong. Look at the number of shares you own. Because you kept reinvesting your dividends, and because the price was falling, each dividend check bought you more and more shares. Your stake in the company exploded from 500 shares to almost 17,000. And the result? Your initial 10 grand is now worth over $213,000. You made a fortune because the stock price went down. It's wild, but it's true.
And that really brings us to the final and maybe the most important point. This whole strategy isn't about being a stock-picking genius. It's not about trying to time the market or find the next big thing. It's about finding a system that works and then having the discipline to just get out of the way and let it do its thing.
You know, let's just compare this to something like junk bonds for a second. People buy them for the high income, but that income is fixed. It's never going to grow. Plus, the name junk is there for a reason. Historically, you've got about a 6% chance that the company just goes bust and you lose over half your money. With these dividend stocks, sure, the starting yield might be a little lower, but you own a piece of a great growing business, and your income grows right along with it.
Here's a question for you. It's from the old radio show A Prairie Home Companion about a fictional town called Lake Wobegon, where all the children are above average. It's a funny line, but it points to a very real human bias. We all like to think we're a little bit smarter than everyone else. And investors, we're the worst offenders.
But the cold hard data tells a different story, and this just perfectly shows the price we pay for that overconfidence. Look, over a 20-year span, the stock market itself returned over 9% a year. But the average person investing in it, they made less than 4%. And why is that? It's because we let our emotions get the best of us. We get greedy and buy when things are high, and we get scared and sell when things are low, the exact opposite of what we should be doing.
So, to wrap it all up, what are the big lessons here? First, consistency is king.
That track record of a dividend aristocrat is one of the most powerful signals you can find. Second, compounding is your superpower. You just have to let it work its magic over time. Third, patience is where the real money is made, especially when the market is scary and you can buy more for less. And finally, the biggest battle is the one in your own head. Discipline beats emotion. Every single time.
So I'll just leave you with this final thought. We live in a world that screams at us to do something, to trade, to check our portfolios constantly. But what if the most powerful, the most effective way to build serious, life-changing wealth is to find a few great companies, turn on that compounding machine, and then have the courage to do nothing for the next 30 years? Something to think about. Thanks for listening.
All right, so when a company hits it big, I mean really successful, it gets this amazing problem to have, a giant pile of cash. Now, what it does with that money, well, that tells you pretty much everything you need to know about its strategy, how confident it is, and what it really thinks about you, the shareholder. Today, we're jumping right into that big debate. Dividends versus stock buybacks. Which one is better? And just to give you a sense of the scale we're talking about, let's take a real-world example. A while back, Microsoft found itself sitting on, get this, $52 billion in cash. I mean, that's just an insane amount of money, right? It's hard to even wrap your head around. But it brings up this huge question that every successful company has to answer. Who's in charge of that cash, and what's the smartest thing to do with it? So, here's how we're going to break it all down. First, we'll talk about why having too much cash is a good problem. Then we'll get into the whole allure of the stock buyback and contrast that with the solid commitment of a dividend. We'll also touch on why a pile of cash can actually be kind of dangerous. And we'll wrap up by looking at what a dividend really signals to the market. Okay, so at its core, this whole thing is basically a classic tug of war. You know, once a company is past that initial crazy growth spurt, you start to see this real split in what two groups want. The folks who run the company and, well, the folks who actually own it. And this slide lays it out perfectly. On one side, you've got management. They almost always want to hang on to that cash. To them, it's like rocket fuel, right? They can use it to grow, maybe gobble up a competitor, or just stash it away for a rainy day. But then you have the investors, the people who own the stock. They're looking at that same pile of cash and thinking something totally different, more like, hey, that's actually my money. How about sending some of it my way? You know, let's boil this down to something really simple. Imagine you put some money into your friend's little Italian place, and it blows up. It's a huge hit, making tons of profit. Now you've got a choice. Do you tell your friend, hey, use that cash to open a second location, which, is a gamble? Or do you say, look, this place is a gold mine. Just give me my share of the profits. That's the exact dilemma we're talking about. So, when faced with this choice, management has a go-to move, a favorite play, if you will, and that is the stock buyback. Now look, to be fair, sometimes this makes perfect sense. If management truly thinks their stock is a bargain, then yeah, using company money to buy it is a great investment. But it's not always that straightforward. There's a lot more going on under the surface. So what is a stock buyback exactly? Well, it's actually pretty simple. The company just takes a chunk of its cash, goes out onto the open market, and starts buying up its own shares, kind of like you or I would. When they do that, those shares are basically taken out of the game, which means there are fewer total shares out there for everyone. Okay, now this is where it gets really interesting. Let's look at the math, because it's pretty clever. So picture a company that makes $20 million and has 20 million shares out there. Simple math, right? That's $1 of earnings for every share, what we call EPS. Now let's say the stock trades for 15 times earnings, so the price is $15. But watch what happens when they buy back 2 million of those shares. The company's profit is exactly the same, still 20 million bucks. But now that profit is spread over fewer shares. All of a sudden, the EPS jumps to $1.11. And just like that, the stock price goes up with it. It's almost like financial engineering. And you better believe management loves this because a higher EPS often means bigger bonuses for them. Right, and you see headlines like this pop up all the time, don't you? It sounds great, the stock usually gets a nice little pop, and everyone thinks management is being super shareholder friendly. But there's one little word in that announcement that changes everything, and you really gotta pay attention to it. And that magic word is authorization. See, an authorization isn't a promise, it's not a commitment. It just means the board has given management permission to buy back stock, if they feel like it. They don't have to. This gives them total flexibility. If things look good, they buy. If the market gets shaky, they can just sit on the cash. It's all options, no obligation. And this flexibility can be, let's say, abused. Let me tell you a story about a company called Jarden. So first, they stopped paying their dividend, the actual cash that goes to shareholders. Then they announced this huge $500 million stock buyback. Now, why would they do that? Well, as it turns out, this buyback was perfectly calculated to boost their earnings per share to exactly $4.50. And wouldn't you know it, the top execs had a clause in their contracts that gave them massive stock bonuses, but only if EPS hit that exact 450 target. So they basically took money that should have gone to shareholders and used it to trigger their own multi-million-dollar paydays. Okay, so that brings us to the complete opposite of all that. The other side of the coin, the dividend. And unlike a buyback, which is just an option, a dividend is a cold, hard promise. So let's really line these two up. A buyback, that's just management saying we might do this. A dividend, that's a firm commitment. The research shows that buybacks are often paid for with temporary cash, like from selling off a division. But dividends, those come from the real, steady, ongoing profits of the business. And here's the bottom line. With a buyback, management keeps all the control. With a dividend, you, the shareholder, get the certainty. The check actually shows up. And hey, don't just take my word for it. This isn't just some theory. We've got serious academic research to back this up. This quote here from the Journal of Financial Economics nails it. It says, "Dividends come from permanent cash flow, the real, healthy heartbeat of the business. Repurchases, or buybacks, often come from temporary cash. It's the difference between a steady salary and a one-time lottery win. One tells you a lot more about financial health than the other." And this right here is the absolute key. Once a company's board officially declares a dividend, it's not just a plan anymore, it's a legal debt. They must pay it. Because if they don't, if they even think about cutting that dividend, Wall Street goes into a complete panic. It's seen as a massive red flag that something is deeply wrong and the stock will get hammered, no question. So when a company commits to a dividend, they are putting their money and their reputation right on the line. Now, this might sound a little weird, but having too much cash just lying around can actually be really dangerous for a company. It's like it's burning a hole in their pocket. And a good, disciplined dividend policy, it's the best medicine for that. And I love this quote because it comes from a CFO, a guy who deals with this stuff every single day. He basically says that hoarding cash leads to bad habits. I mean, think about it. If you have a mountain of cash, you're tempted to spend it. A so-so deal might start to look pretty good just because it's something to do with the money. But a dividend changes that. It forces discipline. By promising a slice of the profits to shareholders every quarter, it makes management think a lot harder about how they spend every single dollar that's left over. And one of the big reasons for these bad habits is a metric called return on equity, or ROE. Basically, it's a score for how well a company is using your money, the shareholders' money, to make a profit. Here's the problem. That big pile of cash on the balance sheet earns next to nothing, so it drags that ROE score down. And that creates this enormous pressure on management to do something with the cash, like buy another company, just to get the ratio back up, even if the deal itself is a total dog. And that pressure can lead to some truly epic disasters. The textbook example of this is the Quaker Oats Snapple deal. Quaker had all this cash, they were feeling the pressure, so they went out and bought Snapple for $1.7 billion. Pretty much everyone in Wall Street was shouting that they were crazy, that they were overpaying, and guess what? They were. Just a few years later, they had to dump Snapple for only $300 million. Poof, $1.4 billion of shareholder money just gone, vanished. So all of this leads to a really important point. When a company makes the choice to pay a steady and hopefully growing dividend, it's not just a financial transaction. It's sending a message to the market. And believe me, that message is louder than any fancy press release. Just look at a company like Abbott Laboratories. Their CFO says it right here. The dividend is part of their investment identity. It's who they are. They've raised their dividend for more than 40 years in a row, and by doing that, they attract a specific kind of investor, right? Someone who's in it for the long haul, someone who values that steady, reliable return. So does this actually work out for shareholders in the long run? Oh yeah, take a look at this. Eaton Vance, another one of these long-term dividend payers. Over 25 years, if you just reinvested your dividends, the stock absolutely crushed the S&P 500 by over 5,800%. That is the incredible power of a company that truly puts its shareholders first. Look, at the end of the day, you can listen to all the happy talk from CEOs on their conference calls, or you can just watch what they do with the cash. Raising a dividend. That cuts through all the BS. It is the single clearest signal that management can send that they are truly confident about the future, not just next quarter, but for years to come. So from now on, whenever you see a news alert that some company is returning billions to shareholders, I want you to stop and ask yourself one simple question. Is this a real commitment, a dividend that they have to pay, or is it just a buyback authorization, a flashy headline that lets them keep all their options open? Because the answer to that question, well, it tells you just about everything. What if I told you the secret to getting rich was, well, to be boring? Yeah, I know, it sounds completely backward. But today, we're going to dig into a strategy for building wealth that is so powerful, but almost nobody talks about it. It's not about finding the next big thing or perfectly timing the market. Nope. It's about something way simpler, way steadier, and you know what? Way more effective. Let's jump in. Just let that sink in for a second. Triple your money in a decade with stocks that are, by definition, underperforming the market on price alone. It feels like a riddle, doesn't it? It just doesn't make any sense. But what you're about to see is that this isn't some kind of clever wordplay. It's a rock-solid principle for building long-term wealth that most people, and I mean most, completely miss. So how in the world do we solve this puzzle? How do you get these incredible returns from losing stocks? Well, the first step is actually to unlearn a lot of the common investment advice you've probably heard your whole life. You know, the stuff that's actually costing people a fortune. Let's start by busting a huge myth. All right, first up, we're going to talk about the hidden cost of help. We're tackling this huge idea in the investment world that you have to pay a team of Wall Street geniuses to manage your money. We're going to see how this so-called help can be a massive silent drain on your financial future. You know, I remember when I first started investing. I was young, just out of school, and I wanted to do the responsible thing. So I did exactly what everyone told me to do. I put my money into a mutual fund and handed it over to the professionals. I really thought I was being smart, but it turns out I was making a rookie mistake, a really expensive one, and it's a mistake I really want to help you avoid. I mean, just look at these numbers. Seriously, this isn't just a chart, it's a giant wake-up call. The overwhelming majority, 85% of these so-called experts, the people you're paying big bucks to, don't even beat the market average. You're paying them a premium for the privilege of them underperforming. It's absolutely wild when you think about it. Okay, let's make this really simple. Imagine you have two paths in front of you. Path 1, you invest your money yourself, buying a handful of solid dividend-paying stocks and paying a tiny commission fee one time. Path 2, you give your money to a managed fund that skims a small 1% off the top every single year. Let's see what happens after a couple of decades. And this right here is where it all unfolds. On the one hand, with your own stocks, you paid $100 in fees and your 10 grand grew to over 111,000. Amazing. But in the mutual fund, those tiny fees added up to almost $16,000, and your final value is just 58 grand. You end up with almost half the money. It's not just the fees you lose, it's all the growth that money could have had. And on a bigger portfolio, say $100,000, those fees can add up to over $41,000 over 20 years. That's a new car. It's a huge down payment on a house. Think of it like a tiny leak in a huge water tank. At first, it's just a drip, but over 20 years, the tank is half empty. That money, that should have been yours. So we figured out how to stop the bleeding by avoiding those killer fees. Now for the fun part. What do we actually invest in? And this is where it gets really counterintuitive, because we're going to challenge another old piece of advice, that you have to take big risks to get big rewards. You're about to see why the opposite is often true. Now, to really get why boring stocks win, we have to talk about something called beta. Don't worry, it's pretty simple. Think of beta like a car's suspension. A high beta stock is like a race car with a super stiff suspension. It's exciting, but man, you feel every single bump in the road. A low beta stock is more like a big, comfy luxury sedan. It's a much smoother ride. And as you'll see, that calm, steady ride can often get you to your destination a whole lot richer. Just take a look at these companies. Con Ed, McDonald's, Coca-Cola. Yeah, not exactly the exciting, high-flying tech stocks you hear about on the news every night, are they? These are the steady, predictable companies that have been around forever. And you can see it in their low beta scores. But don't let that boring label fool you, because when you look at the returns, they are anything but. Okay, now here is where it gets really interesting. This is just the price appreciation over 10 years, no dividends included yet. The overall market, the S&P 500, went up 10%. Not bad. But look at McDonald's, 279%. Exxon, over 116%. These quote-unquote boring stocks absolutely demolished the market. And we haven't even gotten to the secret sauce yet. And here it is. This is the turbocharger. When you add in the dividends and, this is crucial, reinvest them, look what happens. That McDonald's return jumps to 381%. The S&P 500 total return was just 30%. This is the power of compounding. You're not just earning a return on your money, you're earning a return on your returns. It's like a snowball that just gets bigger and bigger as it rolls downhill. All right, so reinvesting dividends supercharges your returns. We get that. But now we're going to take it one step further into something that sounds, well, it sounds completely wrong. We're going to explore the idea that a slower growing stock can actually make you more money than a faster growing one. I know, it sounds nuts, but stick with me. So let's run a little thought experiment. We've got two identical stocks, $10,000 into each. They both pay the same dividend. They both grow their dividend at the same rate. The only difference? Stock one's price inches up at a sleepy 1% a year. Stock two is more of a go-getter, growing at 5% a year. Now, which one would you rather own? So you let 20 years go by. You let the dividends reinvest. You let them compound. Which portfolio comes out on top? It has to be the faster growing one, right? I mean, that's just common sense. Or is it? And here's the shocking answer. The slow and steady stock, the one that barely grew in price, after 20 years, it's worth over $145,000. That is a fantastic return. But what about the one that looked like the clear winner? The faster growing stock, it's worth $128,000. That's not bad, but it's almost $17,000 less than the boring one. So what on earth just happened? How is slower better? It's not magic, it's math. It's all about accumulation. See, because the stock price of the boring companies stayed lower for longer, every time a dividend was paid out, you could afford to buy more shares. Over 20 years, you ended up with almost 12,000 shares in the slow portfolio versus less than 5,000 in the fast one. More shares means more dividends, which means you buy even more shares, and that snowball of wealth turns into an avalanche. So we've seen the power of boring stocks, we've seen the magic of reinvested dividends, and we've seen how slow growth can actually be a secret weapon. Now let's bring it all home and see what this actually means for you, for your financial goals. Let's talk about a realistic path to becoming a millionaire. This is where the dream starts to feel very, very real. Just look at this. $1 million isn't some impossible dream. It's an achievable destination. With the kind of consistent double-digit returns that this dividend strategy can give you, and a little bit of time, you can turn a pretty modest nest egg into a truly life-changing amount of money. 19 years. That might sound like a long time, but trust me, as a guy who's pushing 50, it goes by in the blink of an eye. I think about when my kids were born. It feels like it was last week. If I'd started a $100,000 portfolio for them back then with this strategy, their college would be more than paid for by now. It's just a powerful reminder that the best time to start was yesterday, but the second best time is right now. So what's the big takeaway here? It's actually incredibly simple. First, embrace the boring. The steady, low-volatility companies are your friends. Second, relentlessly, automatically reinvest every single dividend. And third, be patient. Let time do the heavy lifting for you. That's it. That's the whole game plan. Look, the next 19 years are going to go by whether you do anything or not. That's a fact. So you have a choice. You can let them just pass, or you can put them to work building a future for yourself. The choice is yours. Thanks for tuning in. All right, so if you're an income investor, you're probably pretty familiar with your basic dividend stocks, right? But what if I told you there's a whole other world of investments out there? I'm talking about things that are specifically built from the ground up to generate even higher yields. In this explainer, we're going to go way beyond the basics. We're going to explore 5 really powerful and maybe a little lesser known ways to seriously boost your portfolio's income. I mean, for most of us, the answer to this is a pretty obvious yes. I mean, who isn't? Whether you're planning for retirement or just trying to make your money work a little harder for you right now, maximizing that income is a huge goal. And the good news is there are specialized investments designed to do exactly that. They operate a little differently than the stocks you might be used to. So here's our game plan. We'll start by peeking beyond those regular dividend stocks. Then we'll take a deep dive into 4 specific types of investments. We're talking closed-end funds, then MLPs and REITs, after that BDCs, and we'll finish up with preferred stocks. And of course, at the end, we'll pull it all together with the most important takeaways you need to know.
Okay, now I want to be upfront about this. The investments we're about to get into are, like the source material says, often lesser known and a little more complicated. But please don't let that scare you off, because once you get a handle on how these things actually work, they can become incredibly powerful tools for generating some serious income.
Okay, first things first, we need to get a really key difference straight in our heads. Think about a regular mutual fund. The price you pay for a share, it's locked directly to the value of all the stuff inside it, the net asset value, or NAV. Simple. But closed-end funds, we'll call them CEFs, they're a totally different animal. They trade on an exchange, just like a stock. And because of that, their price is all about good old supply and demand. And this is where it gets interesting. It means the price you see on the screen can drift away from what the assets inside the fund are actually worth.
And that gap, that little bit of space between the market price and the real value, creates the single most attractive feature of a CEF, the chance to buy at a discount. This is the real magic of it. You could, and I mean this literally, buy $1's worth of professionally managed assets for 90 cents, maybe even less. It's an incredible concept.
So before we get any further, let's make sure we're totally clear on this term, net asset value, or NAV. All it is, really, is the fund's true per-share value. You take everything the fund owns, subtract its liabilities, and divide by the number of shares. That's the bedrock number, the real value that we're always going to compare the stock price against. Now, this can go one of 2 ways. If a fund gets really popular, a surge in demand can push the price up to a premium. That means you're actually paying more than the underlying assets are worth. But the real opportunity, the sweet spot, is in the opposite situation. When a fund trades at a discount, that's when you get to pay less than what the assets are worth, which can just supercharge your returns and your yield.
And this slide right here shows you exactly how this plays out in the real world. Let's just look at this example fund. Find the 1YR row. See that? The fund's actual assets, the NAV, returned over 6%. Pretty good. But the market price that investors were paying, it only returned about 4%. Now look at year to date. The NAV was actually positive, but the market price was negative. This is that gap between value and price in action. It's a living, breathing thing.
All right, next up, we're going to look at 2 investments that are kind of like cousins, master limited partnerships, or MLPs, and real estate investment trusts, or REITs. Now, what ties these 2 together is a special corporate structure that basically lets them bypass corporate taxes and turn into these profit pass-through machines, which, as you can imagine, is fantastic news for us income investors.
Now, to really get a handle on MLPs, we have to understand this idea called return of capital. Try to think of it like this. Unlike a normal dividend, this kind of payout isn't immediately taxed as income. Instead, what it does is it just reduces the price you originally paid for your investment. So if you bought a share for $10 and you get a $1 return of capital, the IRS now considers your cost to be $9. You only pay taxes on that deferred income way down the road when you finally decide to sell. And this return of capital concept is really the key to MLPs. By law, they have to pass almost all of their profits directly to shareholders, which lets them skip corporate taxes. And a big chunk of that payout is considered a return of capital, making them super tax efficient. So what's the catch? Well, they're heavily concentrated in the energy sector. Think pipelines. Also, you're going to get a more complicated K-1 tax form instead of a simple 1099. And because they pay out pretty much everything they earn, if those earnings dip, a distribution cut can happen fast. REITs use that very same pass-through idea, but they do it for real estate. We're talking about companies that own everything from apartment buildings and shopping malls to data centers and even cell towers. Just like MLPs, they have to distribute most of their profits, and that means high yields for you. So what are the main differences? Well, for one, REIT dividends are usually taxed as ordinary income, not return of capital. And, as you'd expect, their performance is tied directly to the ups and downs of the real estate market.
Okay, our next investment type is really fascinating. It's business development companies, or BDCs. Think of BDCs as your personal ticket into the world of private equity, an arena that, honestly, used to be completely off limits unless you were already incredibly wealthy. So how do they actually work? Well, a BDC's entire reason for being is to provide money, or capital, to small and medium-sized private companies. They do this in two main ways. Either they act like a bank and make loans, often at pretty high interest rates, or they buy a piece of the company, an equity stake, getting in on the ground floor long before that company ever thinks about going public.
And we're not just talking about flashy tech startups here. The source material gives some great down-to-earth examples of the kinds of businesses BDCs invest in. A company that makes irrigation systems for farms, a sand and gravel supplier, even a regional pizza chain. These are the engines of the real Main Street economy.
You know, I absolutely love this quote from the source material. It just perfectly captures the whole appeal of BDCs. I mean, we all dream of investing in the next big thing before it goes public, right? In the past, you needed to have some kind of inside connection. You had to be playing mahjong with the right person at the right time. BDCs basically democratize that entire opportunity. And that brings us to our final investment, the preferred stock. This one is a really interesting hybrid. It kind of sits right in that middle ground between a common stock and a bond, and it borrows features from both to create a uniquely stable income investment. A really crucial feature of preferred stocks is their relative safety. This slide shows you the pecking order in a worst-case scenario, like a bankruptcy. The bondholders, they get paid first. No surprise there. But right after them, you've got the preferred shareholders. They get their money back way before the common stockholders, who are dead last in line. So that priority gives you a really significant layer of security. Another key term here is par value. This is usually the price the stock was first issued at, let's say $25, and it's the number that the fixed dividend is calculated from. Now, here's the trick. If you can buy that $25 par value stock on the open market for, say, $24, your effective yield on that investment is instantly higher than the stated dividend rate. You're getting the same payout on a smaller investment. So let's just sum up preferred stocks. You get a fixed dividend that's usually higher than what the common stockholders get, and the price tends to be a lot less jumpy. In exchange for that stability, you typically give up your voting rights. Now, a fantastic feature to look for is the word cumulative. It means if the company ever misses a dividend payment to you, they are legally obligated to pay you back in full before the common stockholders see another penny. The biggest trade-off? That fixed dividend almost never grows. What you see is what you get. Okay, we have covered a lot of ground. We've explored 5 very distinct types of high-yield investments. So let's bring it all home and compare them side by side. This is where we'll really nail down the key takeaways. This summary table is basically your cheat sheet. For CEFs, the huge feature is that potential discount to NAV, but you always have to remember the price is driven by market mood swings. For MLPs, it's all about that sweet tax-deferred income, but you've got the K1 form and that heavy energy focus to deal with. REITs, high yields from real estate, but they come with real estate market volatility. BDCs offer that really exciting access to private companies, but that comes with higher risk. And finally, preferred stocks give you a stable, fixed dividend with priority payment, but with little to no chance for that dividend to grow. You know, if you remember only one single thing from this entire explainer, please let it be this direct advice from the source material. Consult your tax professional with any questions specific to your situation. I cannot stress this enough. These investments have really unique tax rules, so please always get professional advice to see how they would actually fit into your own financial picture. So I'll just leave you with this to think about. Now that you've got these 5 different tools in your potential toolkit, which one, or maybe which ones, seem like they might be a good fit for your goals? And more importantly, what's the very first question you're going to ask your tax pro about it? Welcome, everyone. So you want to build a dividend portfolio from the ground up? You've come to the right place. We're going to walk through the complete playbook, step by step, to help you create a stream of income that can grow year after year. Look, I know you've heard this a million times. We all have. But when it comes to investing your hard-earned money, this isn't just some folksy old saying. It is the golden rule. It's the bedrock, the foundation of any smart financial plan. And for dividend investing, well, it's absolutely non-negotiable. And hey, if you think that's just some cliche, let's take a quick trip back to 2008. The financial crisis was a brutal, real-world lesson in what happens when you ignore this rule. People who had everything tied up in one sector or one type of asset, they learned the hard way why this one simple idea matters more than anything else. Okay, let's dive into the playbook. We're going to start with that one foundational rule, diversification. Then we'll build out your personal investing blueprint. After that, the really fun part, the compounding wealth machine. Then I'll give you the toolkit you need to find the right stocks, and we'll finish up by looking at the common traps you absolutely have to avoid. All right, first things first. Before you even think about buying a single stock, we have to build a solid foundation. And like we said, that foundation is diversification. It's really just about making sure that if one part of your portfolio takes a hit, another part is there to pick up the slack. Simple as that. Now, a truly balanced portfolio, it's not just about owning a bunch of different stocks. It's about owning different kinds of investments. Think of it like you're building a team, right? Stocks are your high scorers. They're there for growth. Bonds are your defense. They bring stability. Real estate can provide income. They all play a different role, and they shine in different types of markets. But we're not done yet. It's not enough to just own these big categories. You've got to spread your bets within each one, too. So for stocks, that means a mix of big, stable companies, your large caps, along with some smaller, high-growth companies. And you definitely want some international stocks in there to protect you if the US market has a bad year. It's about layers of protection. Okay, so you've got this broad, diversified foundation in place. Great. Now it's time to get personal and create your investing blueprint. See, this isn't a one-size-fits-all kind of deal. Your strategy has to start with you answering two absolutely critical questions. First question, what is this money for? I mean, really, are you trying to generate income that you can live on right now? Or are you playing the long game, reinvesting those dividends to build serious wealth for the future? Your answer here is going to change everything about the kinds of stocks you buy. And that leads us to the second question. What's your time frame? How soon are you going to need to access this money? I can't stress this enough. Your answer here is so important because it'll tell you if dividend stocks are even the right choice for you in the first place. And here's the rule of thumb. If you need this cash in less than 3 years, the stock market is just too risky. It's too much of a gamble. But if you've got at least 5 years, and ideally 10 years or more, well, that's the sweet spot. That's when this strategy really comes alive and can create some serious wealth. And now we get to the really exciting part. This is why having a long time frame is so powerful. Let's talk about the incredible, almost magical power of compounding. This is where a good dividend stock goes from being just an income stream to a true wealth-building machine. Let's just run through a quick example. Imagine you buy a solid company that pays a 4.5% dividend yield. Pretty good start, right? But here's the secret sauce. That company also increases its dividend by 10% every single year. You wait 10 years, your yield on your original cost has now ballooned to over 10%. You've more than doubled your income stream. Just let that sink in for a second. We go just another 2.5 years down the road, and the total cash you've collected in dividends now equals your entire initial investment. You've gotten all your money back, and guess what? You still own the stock. Everything from here on out is pure profit. But why stop there? Let's keep this going. By year 15, that same stock that you bought with a 4.5% yield is now paying you a staggering 17% every single year on your original investment. I mean, that's the magic of compounding dividend growth in action. And what if you just hold on for 20 years? At that point, you've collected 2.5 times your original investment in cash dividends alone. And all this time, you still own the asset, which itself has probably gone up in value. It's just incredible. So the big question is, how do you find these incredible compounding machines? Well, it's not about getting lucky. It's about knowing what to look for and having the right tools for the job. Let's break down the 3 essential metrics you have to analyze for any dividend stock you're considering. First up, the one everybody knows, yield. It's a simple calculation, right? It just tells you how much income the stock is paying right now compared to its price. It's an important starting point for sure, but trust me, it is far from the whole story. Next, and you could argue this is even more important, is the payout ratio. This metric is your safety check. It tells you what percentage of a company's profits are being paid out as dividends. It answers the single most important question, can this company actually afford to keep paying me? Now, here's a crucial point. You can't just calculate this based on a company's net income. That's what I call the accountant story. It can be easily manipulated. No, what you need to look at is the cash flow, the actual cold, hard cash the business is generating. That tells you the real story of whether a dividend is safe. Let's make this super simple. Imagine you own a little Italian restaurant. It makes $200,000 in operating profit, but your accountant subtracts $100,000 for depreciation, the wear and tear on your pizza ovens. But that's not real cash leaving the bank. So the accountant's story says you made $100K, but the real story, the cash flow, is that full $200K. That's the number that matters. And the final tool for our toolkit is the dividend growth rate. This is the engine. This is what powers that whole compounding machine we just saw. A decent starting yield is nice, but it's that consistent year after year growth that really creates those life-changing long-term returns. All right, finally, no playbook is complete without a section on what not to do. It's one thing to know the strategy, but it's another thing entirely to avoid the common mistakes that can derail even the smartest investors. So let's cover the big ones you need to watch out for. Okay, I need you to burn these 3 rules into your brain. First, do not chase those crazy high double-digit yields. A 15% yield isn't a gift, it's a giant red flag that the market thinks that dividend is about to get cut. Second, don't try to time dividend payments. Buy great companies you want to own for years, not just for next Tuesday's payout. And finally, ignore those one-time special dividends. They're a nice bonus, but you base your decisions on the regular, reliable dividend. You see, in the end, this whole playbook, it's about more than just picking stocks. It's a different way of thinking. It's about a shift in your mindset from a short-term speculator to a long-term wealth builder. And it really all boils down to you asking yourself this one simple question. Are you investing for next quarter or for the next generation? What if you had an actual blueprint for your finances? A system designed not just to grow your money, but to create a reliable income stream that actually gets bigger year after year. Well, today we're going to unpack exactly that. It's called the 10-11-12 system, and it's a clear, actionable path to building real long-term wealth. Let's dive right in. This is really the big question, isn't it? For anyone who wants their money to work for them, this is the ultimate goal. You want to build a financial machine that pays you a steadily increasing salary, no matter what the stock market is doing day to day. The system we're talking about, it doesn't just offer an answer, it gives you a surprisingly simple and, honestly, an elegant solution. And here it is, the core promise. The name itself is the goal. In just 10 years, the aim is to have a portfolio that's yielding a solid 11% on your original investment. And, on top of that, to have generated an impressive 12% average annual return along the way. Now, these aren't just pie-in-the-sky numbers. They are concrete, achievable targets if you follow the blueprint. So here's how we're going to break it all down today. First, we'll dig into that promise. Then, we'll dissect the 3 key pillars that make it all work. We're going to spend some serious time on safety, because that's crucial. Then we'll look at the growth engines, and we'll even stress test the whole system. And we'll wrap it all up with a simple, powerful checklist you can start using right away. So let's start with that promise. I want you to forget about trying to time the market or making risky speculative bets. This is all about following a repeatable, proven formula. A way to construct an income-producing asset that just works tirelessly for you in the background. All right, let's pop the hood on this compounding machine. See, to build it right, you need 3 absolutely essential, non-negotiable parts. And they all have to be working together in perfect harmony. And here they are, the 3 pillars of the system. First, you've got the current yield. That's what the stock is paying you right now. Second, the dividend growth rate, how fast that paycheck is getting bigger. And third, maybe the most important, the payout ratio. This is your ultimate safety net. Getting the results you want depends entirely on looking at stocks through the lens of these 3 criteria. Now, before we even get to the exciting part, the growth, we have to talk about safety. I mean it. The most important step in building any kind of lasting wealth is protecting what you started with. This is how you avoid those landmines, the investments that can completely derail your entire financial journey. And who better to make this point than Warren Buffett himself? His famous rules are really the bedrock of this entire system. For our compounding machine to really get going, that dividend has to be rock solid, because a dividend cut, it doesn't just stop your income growth, it almost always sends the stock price into a nosedive too. So how do we make sure that dividend is safe? It all comes down to one key number, the payout ratio. It's just the percentage of a company's actual cash, its free cash flow, that it pays out to shareholders. Honestly, This one number tells you almost everything you need to know about whether that dividend is sustainable or if it's in trouble. And here's the simple, actionable rule that's going to keep you out of trouble. You're looking for companies with a payout ratio of 75% or less based on their cash flow. Think of anything higher than that as a serious red flag, a clear signal of potential danger up ahead. Okay, let's see this in action with a real-world example. Back in 2009, the construction giant Vulcan Materials cut its dividend. It hurt a lot of people. But the question is, could you have seen the writing on the wall beforehand? Whoa. Okay, this slide tells a powerful story, and it starts years before the cut. Just look at that payout ratio. In 2006, it hit 100%. That is a massive warning sign. They were paying out every single dollar of cash they made. By 2008, it had just exploded to an insane 262%. The company was literally burning through cash it didn't have just to pay its dividend. And the result? Well, it was inevitable. A huge dividend cut. The lesson here is so clear and so powerful. By just keeping an eye on this one safety number, investors could have seen the disaster coming and protected their money from a really significant loss. All right, now that we've built our safety net, let's shift gears and get to the fun part, growth. Our compounding machine needs fuel, and it gets that fuel from two powerful engines working together. These are the two levers that are going to drive your portfolio's growth. First, you have the starting yield. Think of this as your foundation. We're targeting 4.7% or higher. Then you have dividend growth. This is your accelerator. The goal here is a consistent 10% or more every single year. You really need both of these engines firing to get where you want to go. But here's the beautiful thing about this system. You have some flexibility. This table shows how a higher starting yield can actually make up for a slightly lower growth rate. So, for example, a stock that's yielding 5% with 8% growth ends up being more valuable after 10 years than one yielding 4% with 10% growth. It's all about finding that powerful, sustainable combination. So, the theory sounds great, right? But how does this system actually perform under pressure? You know, in the real world. Let's put it to the test and see how it holds up when the market gets rocky. So for our baseline, we're going to use a pretty conservative assumption that the stock market just returns its historical average of about 7.5% per year. And you have to remember, that long-term average includes every crash, every recession, and every bear market from the last 60 years. So it's a very realistic number. Now check this out. After 10 years, a $10,000 investment grows to over $34,000 in an average market. But here's the part that's truly remarkable. In a decade-long bear market, where stock prices actually fall by about 1.2% per year, the portfolio is still worth over $31,000. It holds up incredibly well. So why is that? And this slide right here, this reveals the secret sauce to the system's resilience. When you are reinvesting your dividends, a bear market is actually your best friend. Why? Because lower stock prices mean your steady dividend payments are buying dramatically more shares. In a raging bull market, you might end up with about 2,500 shares, but in a bear market, you end up with over 21,000. It is a complete game changer. I mean, just let that sink in for a second. This idea completely flips conventional market wisdom on its head. Over the very long term, all those extra shares you bought when prices were cheap start to compound, and they can make you far wealthier than if the market had just gone straight up the whole time. It's a powerful and kind of mind-bending concept. So let's bring it all together. Let's boil this all down into a simple, actionable checklist. These are the 3 golden rules for building your very own 10, 11, 12 portfolio. Here it is. This is your cheat sheet. This is the practical takeaway, the 3 numbers you need to be looking for every time you evaluate a potential investment. A starting yield over 4.7%, an annual dividend growth rate over 10%, and a payout ratio based on cash flow that is safely below 75%. That right there, that's the formula for success. Look, this system isn't a get-rich-quick scheme. It's a blueprint for a financial machine that can compound your wealth for decades. The principles of safety, yield, and growth, they're timeless. So the only question left is, what are you going to build with it? All right, let's get into it. Today, we're going to break down something every long-term investor runs into: dividend reinvestment plans, or as you know them, DRIPs. On the surface, they look like this perfect set-it-and-forget-it way to grow your wealth. But the real question is, are they always the smartest move, or is there a hidden trap you need to know about? Let's find out. Look, if you own dividend stocks, you already know the golden rule. You've got to reinvest those payouts. It's the cornerstone of long-term growth. But here's the thing I want you to really think about. It's not that you do it, it's how you do it. Are you completely sure that the way you're reinvesting right now is the most efficient, the most profitable way possible? So before we get into the nitty-gritty of comparing the different methods, let's just all get on the same page. Reinvesting your dividends is pure compounding magic. Just picture a little snowball at the top of a very long hill. Every single dividend payment buys you more shares, even if it's just a tiny little fraction of a share. And then those new shares start earning their own dividends. That makes the snowball just a little bit bigger, and it starts rolling a little bit faster. You do that for a few decades, and what started as a small snowball becomes an absolute avalanche of wealth.
Right. So the bottom line is, putting your dividends back to work is way more than just a good idea. It's pretty much essential if you're serious about building wealth. It turns your portfolio into this self-fueling machine. The principle itself is dead simple, and it's been proven to work time and time again. But the tricky part, as we're about to see, is in how exactly you fuel that machine.
So how do you actually make this happen? Well, for the most part, you've got two main choices. The first path is to just let your brokerage handle everything for you. The second is to go straight to the source, to the company itself, and sign up for their specific plan. They might sound like they do the same thing, but believe me, they can be worlds apart.
And this really lays out the initial choice you have to make. On the one hand, using your broker is just easy, right? Everything's in one account, it's all tidy, and here's the kicker. Most brokers these days offer this service for free. It costs you nothing. Then there's the other path, dealing directly with each company through their drip. Now, that means you have a separate account for every single stock, which, as you can imagine, can get pretty messy to keep track of. So, let's get the official definition out of the way. A DRIP, a dividend reinvestment plan, is a formal program that the company itself offers. You enroll in it, and from then on, whenever that company pays a dividend, they take that cash and automatically buy you more of their stock, completely bypassing your brokerage account for that one transaction. And then there's its close cousin, the DSPP, or Direct Stock Purchase Plan. This is a little different. This lets you, say, mail a check directly to the company to buy new shares. A lot of the time, these two plans are bundled together, so you can both buy new shares directly and have the dividends from those shares automatically reinvested. Okay, so going direct with the company. It sounds kind of cool, doesn't it? It feels like you're cutting out the middleman, getting closer to your investment, but this is the point where we have to pull back the curtain, because there's a pretty big downside here that's often buried deep in the fine print.
And here it is. This is the heart of the problem. Unlike your broker, who is probably doing this for free, a lot of these company-sponsored drips are just riddled with fees. We're not talking about huge, obvious costs. We're talking about small, pesky charges that are like a constant drag on your growth. It's like trying to get that snowball rolling, but you're having to push it slightly uphill the whole time. Let's make this real. Let's look at a case study. This is the fee schedule for the DRIP offered by Altria. Just take a second and look at this list. There's a fee to set up the plan. There's a fee for optional cash purchases. There are fees to sell your shares. And yes, you're seeing that right. There's even a fee just to reinvest your own dividends. It's a minefield. And it starts from day one. Before you've reinvested a single penny, you're already out $10 just for the privilege of signing up. That's $10 that could have been invested, could have been compounding for you.
But this is the one that really gets me. They charge you 5% of your dividend, up to $3, every single time they pay you. Think about that. They are charging you money to take your money to buy more of their stock. It's just wild. You know, the author of our source material really just says it perfectly here. This fee is literally taking money out of your pocket and putting it into the plan administrators. Let's say you get a $100 dividend. Because of this fee, only $97 actually goes to work for you. That $3 might not sound like a lot, but quarter after quarter, year after year, it's a completely unnecessary drag on your returns. And I want to be clear, this is not just an Altria thing. Here's another one, Clorox. Their plan dings you with a $15 setup fee right out of the gate. Now, they don't charge for the actual dividend reinvestment, but that initial hurdle is even bigger. You've got to ask yourself, why would I pay for this when my broker does it for free? So at this point, you're probably thinking, okay, got it. Stick with my broker, avoid the fees.
case closed. But not so fast. There is one huge, massive exception to this rule. There is a single feature that can completely flip the script and turn a company's DRIP into one of the most powerful tools you have as an investor.
This is the wrinkle that changes the entire math. It's this special little perk that your discount broker almost never gets you access to. It's kind of an insider benefit that a small number of companies offer directly to their most loyal shareholders, the ones who sign up for their DRIP.
And this is it, the holy grail, the shareholder discount. A handful of companies, as a reward for dealing with them directly, will let you reinvest your dividends at a discount to whatever the stock is trading for on the open market. We are talking about getting shares for cheaper than anyone else can buy them. And this makes it crystal clear. Let's take Aqua America. When our source was written, the stock was trading for $21.57. But if you were in their DRIP, your dividends were buying shares at just $20.50. That is an instant, guaranteed profit on every single dollar you reinvest.
Let's not mince words here. This is like getting free money. Every dividend check you get is suddenly supercharged with 5% more buying power. You are fundamentally buying assets for less than they are actually worth on the public market, and you get to do it over and over and over again. And this discount, it kicks off this incredible virtuous cycle. Your dividend buys you more shares than it should. Those extra shares then generate more dividends next quarter, and that bigger dividend then buys you even more discounted shares. It is like pouring gasoline on the fire of compounding. And this isn't some unicorn. Healthcare Realty Trust is another company that offers a similar 5% discount, and they do it with no fees.
Okay, so we've seen the big, ugly pitfall, the fees. And we've seen the incredible game-changing benefit, the discounts. So let's wrap this all up into a simple, actionable checklist you can use for any stock you own or are thinking about owning. Here's your 4-step game plan. It's that simple. First, you go to the company's website, find the investor relations section. Second, you have to be a detective. Dig into that DRIP paperwork and find every single fee. Setup, reinvestment, sales fees, all of them. Third, and this is the absolute key, you search for that magic word, discount. And finally, you just do the math. Does the power of that discount completely overwhelm the cost of any fees when you compare it to the free option your broker gives you? And that really brings us to the final verdict, the bottom line. For most of your stocks, the simplicity and, more importantly, the zero-cost option of reinvesting through your broker is going to be the smartest play. You should only, and I mean only, go through the hassle of a company's direct plan if it offers a shareholder discount big enough to crush any fees they charge. So I'll just leave you with this little challenge. Go take a look at the dividend stocks you already own. Go to their investor relations pages and do a little digging. You might just be surprised to find that one of them has been sitting there, offering you this incredible deal this whole time. Now you know the secret of what to look for. Happy hunting. Hey everyone! You know, a lot of investors hear the word options and they get a little nervous, and honestly, for good reason. But what if I told you there's a way to use them not for some crazy speculation, but as a tool to actually turbocharge the returns on the stocks you already own? Well, that is exactly what we're going to dive into today. Yeah, let's just put it right out there on the table. For so many people, the word options just conjures up these images of insane complexity, huge risks, and, those horror stories of people losing their shirts. And that caution, it's completely understandable. But here is the secret, and this is the key that changes the entire game. Almost every single one of those horror stories you've heard, they're about people buying options. Today, we are going to flip that script entirely. We're going to look at how to be on the other side of the trade, how to be the seller, the one who, far more often than not, ends up on the winning side. So here's our game plan. We're going to break it down into 5 simple parts. First, we'll bust that big options myth. Then I'm going to give you a really powerful way to think about this, your portfolio's espresso shot. After that, we'll walk through a real-world example of how covered calls actually work, we'll uncover the seller's secret advantage, and then finally, we'll figure out if this is actually the right move for you and your goals. All right, let's get right into it and tackle that options myth. To really get why being a seller is a completely different world from being a buyer, we just need to do a quick review of the 2 basic types of options. It's actually pretty simple when you break it down. A call option gives the buyer the right to buy a stock from you at a price you both agree on. A put option gives the buyer the right to sell a stock to you at an agreed-upon price. Now, for the buyer, the magic phrase is right but not obligation. But for you, the seller, the most important part is this: you get paid. You collect immediate cash just for taking on that potential obligation. Okay, now here's my absolute favorite way to think about the strategy we're talking about today. I want you to stop thinking of this as some risky side bet. Instead, think of it as a performance enhancer for the investments you already have. Think of your portfolio of good, solid, dividend-paying stocks, right? That's like a good, strong cup of coffee. It's reliable, it's steady, it gets the job done. But selling covered calls, that's like adding a shot of pure espresso. It's that extra kick of income that can really push your returns into a whole new gear. So, what in the world is a covered call? Well, the covered part is the most important piece. It just means you already own the stock. You're not making some crazy speculative bet. You then sell a call option against those shares you own, which is basically just an agreement that says you're willing to sell your stock at a certain price, that's the strike price, by a specific date, but only if the buyer wants to. So that's the theory, but theory is one thing. The best way to really wrap your head around this is to walk through a real-world example. Let's put some actual numbers on the table and see how this plays out in different scenarios. Okay, so let's set the scene. Imagine you own 100 shares of Microsoft, and you bought them for $26 a share. You decide to sell a call option that expires in 6 months, and you set the strike price, the price you agree to sell at $30. Just for selling this option, a buyer pays you what's called a premium. Let's say it's $1 per share. That $100 is yours. It's deposited right into your account, and you get to keep it no matter what happens next. It's instant income. So the big question is, what happens when those 6 months are up? Well, let's look at the best case scenario. The stock price does well, it goes up, but it finishes just under that $30 strike price, say at $29.99. The call option you sold, it expires completely worthless. The buyer has zero reason to buy your stock for $30 when they can get it for less on the open market. So what happens? You keep your stock, which is now worth more, and you keep that $1 premium. That's a double win. Now, you have to look at the other side of the coin. What's the absolute worst that could happen? Let's say the company has a disaster and the stock goes to zero. Obviously, that's a terrible outcome for your stock. But what about the option you sold? It also expires worthless. Here's the key, though. You still keep that $1 premium you collected up front. Now, it's not going to save you from the loss, but it does act as a small cushion. It effectively lowers the price you paid for the stock in the first place. And finally, there's the scenario that people often think of as the risk here. I prefer to call it the annoying scenario. The stock does fantastic. It shoots way up to $33 a share. Well, because the price is above your $30 strike price, the buyer is absolutely going to exercise their option. You are now obligated to sell your shares at that agreed-upon $30 price, so you missed out on that extra $3 of profit. But wait, let's look at what you did make. You made $4 on the stock itself, going from $26 to $30, plus you pocketed that $1 premium. That's a total profit of $5 per share. And here's the punchline. That so-called annoying scenario, the one where you missed out, it still gave you a 19.2% return on your investment in just 6 months. Let's be honest, how many of us would be upset with a return like that? The real risk here isn't about losing your money. It's the risk of missing out on an even bigger gain. And that's a pretty good problem to have. So all of these scenarios seem to work out pretty well for the seller. You might be thinking, okay, this seems a little too good. What's the secret sauce? Why does the seller have such a built-in advantage? Well, let's pull back the curtain and look at the powerful forces that are always working in your favor. As an option seller, you basically have two best friends. Think of them as your partners in this whole thing. And these two factors are constantly at work behind the scenes, helping the value of the option you sold go down over time, which for you is exactly what you want to happen. Your first best friend is something called volatility. The easiest way to think about it is this. The more a stock's price jumps around wildly, the more fear and uncertainty there is. And the more uncertainty there is, the more expensive its options become. For you, as the seller, that's fantastic news. It means you get to collect a much bigger paycheck, a bigger premium, right from day one. And then there's your second and maybe even more powerful friend, time itself. Every single option has an expiration date. It has a limited lifespan. And a big chunk of its price is what's called time value. As every single day ticks by, that value decays. It just melts away, exactly like the quote says, like the sand in an hourglass. This time decay is a relentless, unstoppable force that is constantly working for you, chipping away at the value of the option you sold.
All right, so we've seen how it works. We've looked at the built-in advantages. But just because it's a great tool doesn't mean it's the right tool for every single person. So now we've got to ask the most important question. Does this strategy actually line up with your specific investment goals?
This strategy is almost tailor-made for what we call the income investor. That's someone whose main goal is to generate a steady, regular stream of cash from the assets they already own. It's a bit less ideal for the pure wealth builder, the person whose plan is to just buy great companies, hold them forever, and reinvest those dividends for decades. And why is that? It's because your shares might get called away, and that can interrupt that beautiful, long-term compounding machine. So, let's just boil this all down. What are the key things you absolutely need to take away from this? Number 1, selling covered calls is a fantastic, proven way to boost the income you get from your stocks. Number 2, your real risk isn't losing your investment, it's an opportunity risk, missing out on massive runaway gains. 3, this is not a set it and forget it kind of deal. It takes a little more active monitoring than just buying and holding. And finally, and this is a huge benefit, every time you collect a premium, you are effectively lowering your break-even price on the stock you own.
And that brings us right back to where we started, with our coffee analogy. You've already got your portfolio. That's your solid cup of coffee. So the question I want to leave you with is this. Are you looking for that extra kick? Is it time for you to add a shot of espresso?
All right, let's talk about something that gets every income investor's attention: foreign dividend stocks. You see these huge, juicy yields being advertised, and you have to wonder, is this a golden opportunity or is it a trap? Today, we're going to pull back the curtain and figure out if that high yield is the real deal or just fool's gold. Look, I get it. If you're watching this, you're probably on the hunt for better returns for your portfolio. It's not easy. You look around at the yields on really solid, quality U.S. companies, and you can't help but think, man, there's got to be something better out there. And that's exactly the thought that sends so many of us looking overseas. And this chart right here is the perfect example of why we look abroad. Now, this data is from a little while back, but the idea is timeless. You had high-quality U.S. stocks yielding, a respectable 3.5%. But then you look at some emerging market stocks, and they're dangling a whopping 7% yield. That is literally double the income. I mean, who wouldn't be tempted by that?
So that's the big question, right? Why is the difference so massive? Well, it all boils down to one of the most fundamental rules in all of investing, one you absolutely cannot afford to forget. That extra yield, it's not a gift. There are no free lunches on Wall Street. You should think of it as hazard pay. The market is basically telling you that it sees more danger in that 7% investment. It's paying you a premium to take on that extra risk. Now, our job as smart investors is to figure out if the market is overreacting and the risk isn't that bad, or if the danger is very, very real.
Okay, so let's dive into the first major risk. And it's summed up perfectly by this great piece of Wall Street slang. Foreign dividends are often, well, lumpy. Let's break down exactly what that means for the cash you're expecting in your account.
So what in the world does lumpy mean? It's simple, really. It just means inconsistent. You see, most dividend investors are looking for a steady, predictable, reliable stream of income. Lumpy is the opposite of that. It means the dividend can jump way up one year and then fall right back down the next. It's just not predictable.
And this really gets to a core difference in how companies think about dividends. Here in the United States, consistency is king. Management teams will bend over backwards to raise the dividend even just a little every single year. A dividend cut is seen as a major failure. But for many companies overseas, that culture just doesn't exist in the same way. For them, a dividend is more like a profit-sharing plan. If the company had a great year, you get a big fat dividend. If it was a tough year, you get a smaller one, or maybe nothing at all. And here's what that looks like in the real world. I mean, just look at this. One year, you get $1.65. The next year, bam, it's down to $1.32. Then it rockets up to $1.77. Now, if you're trying to plan your retirement or live off this income, that kind of up and down ride can give you a serious headache. It's just not that smooth, steady climb we hope for. All right, let's move on to the next risk. And honestly, this might be the single biggest and most misunderstood piece of the puzzle. It's currency risk. And here's the absolute key. The dividend a foreign company announces in its own currency
is often not the amount of cash that actually lands in your US dollar bank account.
Now, the way most of us invest in these companies is through something called an American Depositary Receipt, or an ADR. The easiest way to think about it is like a wrapper. It's a certificate that trades on a US stock exchange in US dollars, which is super convenient. But inside that wrapper are the actual shares of the foreign company. And the magic and the risk happens when the dividend from that foreign company gets converted into your US dollars.
Okay, stick with me here. To really get this, let's use a simple, made-up example. Imagine a company in a country that uses the Lichtenfeldian dollar. We'll call it a litchi. Year 1, the company pays a 1 litchi dividend. The exchange rate happens to be 1-to-1 with the US dollar, so you get 1 US dollar. Easy enough. Year 2, the company pays the exact same 1 litchi dividend. But its home currency got stronger. Now that 1 litchi is worth 2 US dollars. Your income just doubled, even though the company's dividend didn't change at all. But then, in year 3, disaster. The company pays its same steady 1 litchi dividend, but the currency collapses. Now your dividend is only worth 50 cents. The company's payout was perfectly stable, but your income swung wildly from $2 all the way down to 50 cents. That, my friends, is currency risk in a nutshell.
You might be thinking, okay, that's a cute little thought experiment, but does that kind of thing really happen? Oh, you bet it does. It happens all the time. So let's stop with the theory and look at the actual dividend history of a real company, a Chilean bank called Corp Banca.
Okay, I want you to focus your eyes on 1 year in this table, 2009. This is where it gets crazy. Look at the middle column. In its local currency, the Chilean peso, Corp Banca raised its dividend. It went up from about 22 cents to 25 cents. That's a dividend hike. As an investor, you'd be thrilled. But now look at the far right column. What did U.S. investors holding the ADR actually get? Their income went down from 61 cents to 49 cents. How on earth is that possible? The currency. The U.S. dollar strengthened against the peso that year, and it literally ate away at their dividend. The company did its job, but American investors still took a pay cut.
So here is the absolute bottom line, the truth you have to accept. When you buy a foreign stock, you're making two completely separate bets. You're betting on the company to do well, and you're betting on its home currency not to weaken against the dollar. The company can be a total rock star, raising its dividend year after year, but if you lose that currency bet, you can still end up with less and less income. This is the #1 reason it is so incredibly hard to find the foreign version of what we call a perpetual dividend raiser.
And if you thought lumpy dividends and currency swings were enough to worry about, well, there are a few more things to keep on your radar. Because remember, when you invest overseas, you're not just buying shares in a company, you're basically buying a small piece of a country.
You've got to think about political risk. What if a new government takes power and decides to change the rules for businesses? Then there's economic risk, like the crazy, out-of-control inflation we've seen in places like Argentina, which can just obliterate the value of a currency. And then you have what I'll call regulatory and information risks. How much can you really trust the financial numbers that the company's reporting? Now look, let's be clear, no system is foolproof. We've had plenty of accounting scandals right here in the US. But for the most part in developed markets, we have strong regulators and accounting rules that give us a pretty high level of confidence in the numbers. In some emerging markets, the rules can be a lot murkier, the oversight isn't as strong, and let's be blunt, the risk of companies cooking the books is just plain higher. It makes it that much harder to know if you're getting the true story. And finally, let's wrap up the risks with two practical, let's call them headaches. First, how often you get paid. A lot of us are used to those nice quarterly dividend checks, but many foreign companies only pay once, maybe twice a year. That can really mess with your cash flow. Second, those big, rare dividend payments are like a magnet for short-term traders, and the games they play can actually hurt you. Yep, this strategy is called dividend capture. It's exactly what it sounds like. Traders pile into a stock right before the dividend is paid just to, well, capture the dividend. And then they sell right after. All that buying pushes the price up temporarily. So if you're a long-term investor who's reinvesting that dividend, you're forced to buy your new shares at that artificially inflated price. It actually lowers your long-term return. It's a game they play, and you can end up on the losing side. Okay, I know what you're probably thinking. I've just spent the last few minutes talking about lumpy dividends, crazy currency swings, political instability, and even sketchy accounting. So after all that doom and gloom, why would anybody in their right mind bother with these stocks? Is there any good reason to own them?
Well, the answer is a resounding yes, and it all comes down to one single, incredibly powerful word: diversification.
The world is a very big place, and not all economies move in lockstep. By spreading your investments around the globe, you protect yourself from having all your eggs in one basket, the U.S. market basket.
And this is just an incredible illustration of that power. It's an extreme case for sure, but think back to the absolute nightmare of the 2008 financial crisis. The S&P 500 here in the US got crushed. It fell 37%. It was a total bloodbath. But in that same year, the stock market in Tunisia gained 10%. Now, I'm not telling you to go put all your money in Tunisia, but it proves a vital point. There is almost always a bull market happening somewhere in the world, and diversification can help you find it, even when things are terrible at home.
So, how should we think about all this? What's the final takeaway? I absolutely love this analogy from the original material. Treat these stocks like dessert. The main course of your portfolio, your protein, your vegetables, that should be your core holdings of reliable domestic dividend-growing companies. But is it okay to have a little dessert? Absolutely. It's even a good idea to have a sprinkling of these foreign dividend payers for that extra yield and diversification boost. The key is just to go in with your eyes wide open, knowing full well that they are not going to be as steady and predictable as your main course.
And so that brings us right to the final question, and this is one that only you can answer. You now understand the trade-off. You're trading consistency and predictability for a shot at higher yield and better diversification. So the question you need to ask yourself, based on your own financial goals and your own comfort with risk, is how much dessert does your portfolio really need?
All right, let's dive into a topic that, let's be honest, can make even the most seasoned investors feel a little bit anxious. And that's taxes. I get it. The moment you see those forms and acronyms, your eyes can just glaze over. But here's the thing. Understanding the basics of how your dividends get taxed isn't just some nice-to-have skill. It's absolutely crucial if you want to maximize your returns over the long run.
And hey, you're not alone in feeling that way. The author of the book we're drawing from, Marc Lichtenfeld, he comes right out and says he was hesitant to even write the chapter on taxes. He just hates how complicated and, frankly, annoying it can all be. And I find that really refreshing because it means we're all on the same page, but it's a hurdle we've got to get over together.
Because let's face it, ignoring how taxes work is basically like volunteering to give away a chunk of your hard-earned investment gains. So, let's try to reframe this. This isn't about you becoming a CPA overnight. No way. This is about you picking up a powerful skill that will directly, and I mean directly, impact how fast your portfolio can grow. So, where do we even begin with all this? Well, back when our source material was first published, there was a nice, simple number that was a fantastic starting point for understanding how dividend taxes worked. And that number was 15%. Now, just a heads up, tax laws have changed since 2012, but understanding how this simple rule worked is the perfect foundation. Back then, for a whole lot of investors, basically anyone in the 25% tax bracket or higher, 15% was the magic number for your qualified dividends. Pretty simple, right?
Now, this 15% rate didn't just fall out of the sky. It was actually put in place by a tax act back in 2003 under President Bush, and then it was extended in 2010 under President Obama. And this is a really important point to grasp. Tax laws are not permanent. They are living, breathing things that change with the political winds.
Which, of course, leads us to the big question. Was it ever really as simple as just remembering one number? You've probably already guessed the answer, and it is a big, resounding no. And this is why. There was always fine print. You see that nice 15% rate? It only applied to what are called qualified dividends. That has to do with the type of company and how long you've owned the stock. It also, like we said, depended on your personal tax bracket. And here's the real kicker. These rates were set to expire. If Congress didn't act, the rate would snap right back to your regular income tax rate, which for most people is a heck of a lot higher. So the lesson here, the devil is always in the details. Okay, let's build on that. Because in today's world, it's super common to own stocks from companies all over the globe. And that, you guessed it, adds another little wrinkle to our tax picture, foreign taxes. So here's the deal. When you get a dividend from a foreign company, their government might take a little slice of the pie before that money ever reaches your brokerage account. The book gives a great example using Telefónica, a big Spanish company. At the time, if you got a dividend from them, the Spanish government would withhold 19% of it. And right away, your brain is probably screaming, whoa, wait a second. Does that mean I pay 19% to Spain and then I have to pay the US government again on the same money? It is a totally fair question. And thankfully, the answer is no, because the system has a pretty clever fix for that. And that fix is called the foreign tax credit. It's actually a brilliant idea. The US government says, hey,
We see you already paid taxes to Spain. We'll give you a credit for that amount so you don't get taxed twice on the same income. You just have to file a specific form with the IRS, Form 1116, and it saves you from that double taxation headache.
But you know the drill by now. There are always some rules to watch out for. First, some countries are great. They don't tax foreign investors at all. But here is the big one, and I really want you to burn this into your brain. You can't claim that foreign tax credit for any stocks you hold inside a tax-deferred account, like an IRA. That credit is just gone. Poof. It's a huge deal, and we're going to circle back to why in a bit.
Okay, we've talked a lot about the rules of paying taxes. Let's switch gears to the more exciting part, strategy. We're going to talk about the incredible power of tax deferral, which is really just a fancy way of saying keeping more of your money working for you for longer.
So one of the main tools for this is something called a return of capital. You'll see this a lot with certain investments like REITs or master limited partnerships. Basically, instead of the company sending you a dividend that's taxed as income this year, they send you a payment that's considered a return of your own money, so you don't pay tax on it right away. Instead, it just lowers the official price you paid for the stock.
Let's walk through this example so it really clicks. Imagine you buy a stock for $10. A little while later, you get a $1 distribution, but it's classified as return of capital, so you don't pay any tax on that dollar today. Instead, the IRS now considers your purchase price to be just $9. Fast forward and you sell the stock for $20. Now your taxable gain isn't $10, it's $11 because your cost basis was lowered. See what happened? You didn't avoid the tax, but you kicked the can down the road. You deferred it until the day you sold. Now, the second way to defer taxes is probably the one you're more familiar with, and it has everything to do with where you decide to hold your investments. We're talking about those special accounts designed for this exact purpose, like your IRA or a 401k. And this chart just shows you how huge the difference can be. The book lays out an example with a $100,000 portfolio. In a tax-deferred account, after 10 years of growth and reinvesting all those dividends, it's worth around $285,000. But in a regular old taxable account, where taxes are taking a 15% bite out of your dividends every single year, it's only worth $262,000. That's a $23,000 difference. That's the incredible, undeniable magic of tax-deferred compounding. Okay, this all brings us to what I believe is the single most important strategic takeaway of this entire explainer. This is the golden rule. It's all about putting the right kind of stock in the right kind of account. This is where you turn knowledge into real money. Pay close attention here, because this slide is the master key to tax-efficient investing. For your regular bread-and-butter dividend stocks, you want them tucked away inside a tax-deferred account, like an IRA. That way, every dividend they pay gets reinvested and grows and compounds without you losing a single penny to taxes along the way. But, and this is the pro move, for those special investments, the ones that pay out that return of capital, you want those in your normal taxable account. Why? Because their payouts are already tax-deferred. Putting a tax-deferred investment inside a tax-deferred account is like wearing a raincoat indoors. It's totally redundant. You get zero extra benefit, and you've wasted that precious, valuable tax-sheltered space. Whew! Okay, we have covered a lot of ground, haven't we? From tax rates to foreign credits to the master strategy of account placement. So let's just take a breath and boil it all down to the core things you really need to walk away with.
Here it is, short and sweet. Number 1, tax laws are always in flux. That 15% rate was then, this is now. Always stay current. Number 2, if you invest overseas, the foreign tax credit is your best friend for avoiding double taxation. Just remember, not in an IRA. Number 3, put your regular dividend stocks in your IRA to let that compounding engine run at full speed. And finally, the big one. Keep those special return of capital investments like MLPs in your standard brokerage account to make the most efficient use of all your accounts.
And that leads me to the final and without a doubt the most important piece of advice here. The author says it over and over, and I'm going to echo it right now. Everything we've talked about today is to help you understand the big picture and ask smarter questions. But tax law is incredibly complex. For your own personal situation, the single best thing you can do is talk to a qualified tax professional. I promise you it's one of the smartest investments you'll ever make.
All right, let's dive in. Today, we're going to talk about an investment strategy, but maybe not in the way you're used to. This isn't about chasing hot stocks or trying to time the market. No, this is more of a philosophy, a way to build real long-term security, and maybe even more importantly, how to build a genuinely richer life. So here's the path we're going to take. First, we'll talk about escaping all that market noise. Then we'll get to the heart of it. Why time is your greatest asset, not perfect timing. We'll see the magic of compounding in action, how this can become a gift for your kids and their kids, and what it really means to live a rich life. And finally, we'll see how it all starts right now. Okay, first things first, let's tackle the biggest problem. Every day, you turn on the TV, you go online, and you're just hit with a tidal wave of financial advice. It's overwhelming, right? And it's almost impossible to know who to listen to. And here's the crazy part about all that noise. The financial media tends to move in these big, predictable ways. One day something is completely out of style. The next, suddenly everyone, from the super optimistic permabulls to the doom and gloom permabears, is screaming from the rooftops that it's the greatest thing ever. The advice you're hearing is often just a fad, a reflection of what's hot right this second. And following these fads can be, well, absolutely devastating. The source material points out something fascinating. A lot of the same experts pushing one idea were pushing the exact opposite just a few years before. They were yelling at everyone to pile into internet stocks right before the dot-com bubble burst. And then they were telling everyone to sell all their stocks at the bottom in 2009, right before one of the biggest market rallies in history. It just goes to show you, following the herd can lead you straight over a cliff. So, if chasing every hot new trend is the wrong thing to do, what's the right move? Well, the answer is surprisingly simple, but it changes everything. It's about shifting your entire focus from timing the market to just spending time in the market. And this lays it out perfectly. Look at these two paths. On one side, you've got market timing. That's the constant stress, the high-risk game of trying to guess the absolute perfect second to buy or sell. And let's be honest, almost nobody gets that right consistently. But on the other side, you have time in the market. This approach is patient. It's calm. It lets the power of compounding do the work, and man, does it take a lot of the stress out of the equation. This right here is the absolute key to the whole thing. You do not need the headache of trying to buy a stock at its rock bottom price to be successful. What matters so much more is just being in the game and letting time, the great equalizer, do all the heavy lifting for you. So what is this heavy lifting I'm talking about? Well, it's a little thing called compounding. You've probably heard of it. It's basically your money making money, and then that money starts making its own money. It's growth on top of growth, and it's where the real magic happens. And this is exactly why patience is the secret sauce. Look, in the first few years, say years 1 to 7, the growth feels fine. It's steady, but it's not going to knock your socks off. But then something starts to shift. Around year 8, year 10, it begins to accelerate. And by the time you're hitting years 15 and 20, the growth isn't just a straight line up anymore. It's a curve that gets steeper and steeper. That little snowball you started is now an avalanche. Let's put some real numbers to this to see what I mean. Let's say you start out with an investment of $100,000. And let's imagine that, between the growth of your investments and the dividends you reinvest, you average a return of about 12% a year. Seems reasonable. Well, after 20 years of just letting it be, letting that snowball roll down the hill without getting in its way, your original $100,000 could be worth over $1 million. That is the incredible real-world power of choosing time in the market over timing the market. And a funny thing happens to your mindset when you see this in action. When that growth engine really starts to hum, you become fiercely protective of it. The idea of pulling your money out or trying to get clever and time the market, it just becomes unthinkable. Why would you ever want to stop that incredible momentum? Now look, this strategy is obviously powerful for your own life, but the real profound impact, well, that can stretch way beyond you. This can actually become a gift you pass down through your family. And it's a pretty simple process, really. First, you get good at this yourself. You master the patience, the discipline, then you teach these exact same ideas to your kids. And by doing that, you give them a foundation of security that empowers them to go chase their own dreams, turning money into a tool for them instead of a source of constant worry. And let's be really clear here. The point of all this is not about leaving behind enough money for mansions and private jets. The real gift, the true legacy, is freeing your kids and their kids from one of the biggest, most universal stressors that we all deal with, worrying about money. And that freedom, well, that freedom is everything. It allows us to completely redefine what it actually means to live a rich life. It has very little to do with the number in your bank account and everything to do with what that number makes possible. So, what is a rich life? It's freedom. It's the freedom to follow your passions. It's having the security to say yes to an opportunity because it excites you, not just because it pays well. It's about having choices, real choices, that aren't dictated solely by a paycheck. I mean, just think for a second about the cost of financial insecurity, not just for us, but for everyone. How many amazing teachers are out there right now, but they never went into teaching because they had to chase a higher salary? How many incredible works of art were never created because the artist had to work 2 jobs just to pay the rent? Or how many people who are natural-born helpers, people who would have been incredible nurses or social workers, spent their entire careers in a job they hated just to make ends meet? That is the real tragedy of financial anxiety. But when you have a plan in place, when you know that your money is quietly working and growing for you in the background, it changes things. It gives you a little bit of courage, that brave decision to go back to school, to start a small business, to take a pay cut for a job you love, suddenly feels possible. It makes being brave just a little bit easier. So, we've gone from the chaos and the noise of the daily market news all the way to this simple clarity of a long-term plan. We've seen how time and patience are the real tools for building security, and how that security can unlock a richer life, not just for you, but for the people you love. So really, it all comes down to this one question. Picture yourself 20 years from now. What's the story you're going to tell? Is it the story of how you chased trends, got stressed out, and reacted to every bit of market news? Or is it the story of how you started today, you were patient, and you built a future that gave you the freedom to live a life that was truly rich? That's the choice.